Good morning, everybody, and welcome to our charity finance team's update. And I'm glad that you could all join us. I think there will still be a few people joining in the next few minutes, but we'll make a start because I know everybody's time is precious. So I'm Michaela Johns, one of the directors at HWB, and I head up the charities and not-for-profit team. And joining with me today are speakers Matt Cooper, who's also a director and RI like myself, Alan Davies, who is a senior audit manager, Joe Wilson, senior tax manager, and Matt Pickett, audit manager, all of which form part of our HWB charities team. So just a few practical points before we start. We will send the slides and any document links we refer to during this webinar, and also publish the YouTube video so that you can share it with your teams and trustees, and that will come out in the next week or two. We do have a few polls during the webinar in order to get your feedback and obviously to check you're still there. So please do scan in this QR code that's on your screen in front of you now using your mobile phone camera, and then you'll be able to give us your opinions throughout the webinar. Okay, so moving on to the agenda for today. We're going to cover the Charity Commission update and overview to begin with. Then Joe will highlight a few tax areas that might be useful reminders for you. Alan Davies will cover the main points from the changes that came in under Financial Reporting Standard 102 on leases. And Matt Cooper will do the same, but on the income recognition changes. Matt Pickett will then cover the Charity Statement of Recommended Practice 2026 points, looking in particular at the main changes for audit-sized charities. Then he will mention the audit limit consultation that's currently in place. And then I will finish off with a general sector update. For any questions throughout the webinar, please use the chat function on Teams, and we will try and come back to you throughout the webinar. And then anything that we've not answered, we will come back to you personally on afterwards. So let's begin with the Charity Commission update. The last time we put on a technical seminar just for charities was back in 2022. And since then, the numbers of charities have decreased by 9%. So I think from this we can conclude that there have been some consolidations in the sector in order to survive, but also quite a few mergers. I have listed in the box there the various bandings of the sizes of charities and the number of charities that are registered. And as you can see, there are many in the first three bands. That amounts to 94% of all registered charities are actually below the 1 million income level, which is currently the audit limit. So what does that mean for you? We think that charity auditors will become even more specialised as some more charities in the next bracket as well, in this 1 to 5 million bracket, will also go out of the need to have an audit, and therefore there will be less charity auditors around. At HWB, we have decided that we will support the sector and will continue to offer audits and non-audit work. And indeed, many of your trustees may still wish to have an audit for good practice reasons, even if you don't have to have it under the Charities Act. The numbers in the first category, this 0 to 10 million income category, have decreased by 13% since 2022. And we have seen that as we think that's really related to the fact that it is harder and harder to get charity approvals through the Commission. And then in the top bracket, the over 5 million sized charities, they have increased by 23%, which shows that these larger charities have grown, or indeed mergers have happened. The numbers of charities that are have linked charities remains very stable at nearly 14,000, and that's very similar to 2022. But on the merger front, which backs up the 9% decrease overall, there has been a surge in that 2024 year. You can see 331 charities merged in that year, quite a big jump from 2023. That sort of number stayed in 2025 after having relatively no numbers in 22 and 23. Again, adding to the trend that to survive in the long term, charities are looking to work together. So moving on to the next slide on the Charity Commission update. We always think it's really good to practice, a good practice to learn from what other charities make mistakes in, and hence we would recommend you to monitor the Charity Commission site and look for the inquiry updates into the charities that the Charity Commission has opened an inquiry on. And on that slide there, I have listed 3 that were in February this year. All have different reasons why the inquiry was opened. And in general terms, inquiries are increasing as the Charity Commission has been giving more funding to look at the issues in the sector. So the first one, Stoke Air Ambulance, the issues were around the activities and administration, and this was the reason given for the inquiry, with the big question being on this one, were they operating within their charitable objectives? And that is an area that is absolutely key for every charity. The second one, Lutterworth, there were financial concerns here, i.e. going concern, cash flow issues, all sorts of things going on there. And again, that's why that inquiry was opened. And then finally, Micklegate, there were issues here over financial controls, basically weaknesses in systems and procedures. So, as I said, I would recommend that you register for these updates and then circulate them to your board for them to read and be familiar with and ensure that your charity couldn't have the same issues as are being reported here. These updates will also give you guidance to give you access to any new guidance that the Charity Commission issue. They do the CC guidance sheets, which are really useful. And again, quite good practice to circulate those to your board. Looking at the number of trustees positions, 921,000 remain very, very similar to 2022, and that really is an impressive number of people giving their time up for free. If you think that each charity will have, say, 4 meetings per year for trustees, that is a lot of hours. In general, we've heard that charities are finding it hard to recruit new trustees. So I thought we would run our first poll so that we can see what your opinion is today. So please go to your phones, call up Slido, and then give us your opinion. Are you finding it harder recruiting trustees now compared to 4 years ago? I think at the moment the consensus is looking like harder, which is probably what we expected. Few of you saying easier, which is great news. Such valuable people to have, giving you that input from the outside. That poll will keep moving as we speak, but I think now it's time to hand over to Joe, who will cover all things tax with just a few reminders. Thank you.
Thank you, Michaela. Good morning. The first thing I wish to cover is just talking about gift aid rules for charity shops. Recently, HMRC have relaxed the gift aid reclaim rules for charities to reduce the admin burden that is placed on them that historically was deemed to be quite extensive. So in place of the requirement to use a mandatory template, HMRC's new guidance will allow charities to use their own end-of-year letters or templates, provided they include the following crucial information: the full name and address of the charity, the name of the donor and their address, the net proceeds from the sale of goods, and the tax year in which that gift aid is impacted in. So hopefully, this is just a summary, but hopefully charities who are operating in the retail sector and using shops will see a reduced admin burden placed on them. One thing I want to remind you is the apprenticeship levy, which is it's like almost like an additional tax on employers with an annual pay bill of over 3 million. And this is designed by the government to fund apprenticeship training. And currently, employers are required to pay at a rate of 0.05% of an employer's total pay bill. And we have a fact sheet on this, which we will distribute later. So it does add to the employer's cost of employing people, and this applies to charities as well. But while there is no cash refund on this levy, this amount can be reclaimed if the charitable organisation incurs costs on training apprenticeships through qualifying schemes. So if you train staff using an approved provider, you can recover the apprenticeship levy and potentially a bit more than what you've paid in. IR35 is always an important consideration. That's another tax issue that comes up not just in the charitable sector, but in lots of sectors. IR35 is also known as the off-payroll working rules, and it's considering whether the person you're engaging with should be treated as an employee rather than a business-to-business consideration. And this comes up a lot if you're using subcontractors, and you may need to consider if you're engaging with a subcontractor, are they really a third-party subcontractor, or are they effectively acting as an employee of yours? If the charity is a public sector organisation or is a medium and large, deemed to be medium large, the charity will be responsible for determining if these off-payroll working rules will apply. I.e. that's the charity it's the onus on the charity to decide whether or not the individual is an employee or not. And examples where this could crop up could be if you're using IT support staff, gardeners, cleaners. So just be aware of that. Just think of the degree of control you have over these people you're engaging with. If you are unsure, you can contact us, and there is a tool on the revenue website where a host of questions can be asked, which will then give the revenue's opinion based on the answer you provided as to whether said individual is employee. Salary sacrifice for pensions. Now, if you use salary sacrifice for pensions for your staff members, it is more tax advantageous to them. This is because the contributions into their pension scheme are being made out of pre-tax rather than post-tax earnings. So the individual is saving tax and NIC at source. Also, this ensures that staff who are on the basic rate tax band will benefit from this, whereas other non-salary sacrifice pension schemes, they won't see the tax benefit. But I want to point out in 2029, it is planned that the amount of NIC savings, not tax, the NIC savings from salary sacrifice pensions will be capped at £2,000 for employers and another £2,000 for employees' national insurance. However, as I said, that's not coming into 2029. That's about 3 years away. So we could see a lot of change, but it is worth being aware that that is currently the government's intentions to cap the pension salary sacrifice. Next point I wish to mention is mandatory reporting payrolling of P11D benefits. These are benefits in kind that are awarded to staff, such as medical insurance, gym membership, company car. And again, HMRC have pushed back the mandatory reporting of this through payroll. So you can still do this as an end-of-year P11D form, but from 2027 onwards, it is expected from HMRC that all benefits will be recorded through payroll, and this will be mandatory. As I said, at the moment, it can be done on a voluntary basis for most benefits, except accommodation benefits and inexpensive loan benefits. But this is something you want to consider putting in place before it becomes mandatory next year. Tax efficient packages, just think of those, like what tax efficient packages you can offer your staff, such as trivial benefits, awarded trivial benefits, which can be tax free if they're under £50 and not reward for services. I've mentioned some salary sacrifice. What about childcare provisions that can be tax efficient, or even offering your staff a cycle to work scheme? There are still tax efficient employment packages that can be awarded to staff that can incentivize them to stay or work at the charity. The next point is to consider if the charity is ever supplying services outside of the UK, it will need to consider its VAT position for the services, the non-UK services provided. And this is not very straightforward, as it can depend on the country in which the services are supplied to, or whether or not the organisation is a business. The next point I want to mention is employers' national insurance, and it's now at 15%, which is 1.2% from what it was a couple of years ago increase. And organisations are feeling the cost of this more and more. But this cost can be reduced by the available employment allowance, which is available to an organisation, and that allowance, which can reduce the bill, is at £10,500. Now, I want to mention that previously there was a cap that prevented employers with a secondary NIC bill from claiming this allowance if their NIC bill was over 100,000, but this cap was removed from April 2025 and it's open to all. So do make sure you're claiming this NIC employment allowance, which can save you up to £10,500 through your payroll. Other points I wish to mention is that as minimum wage has increased from April this year, it's increased to £12.71 for those over 21. For those aged between 18 and 20, it's now £10.85, and for under 18-year-olds and apprentices, it is £8 an hour. The other point to mention is that the Valuation Office Agency will implement a business rates revaluation on the 1st of April 26, but this is based on property values as of April 24, and it will impact commercial properties. Sadly, the deadline for making an appeal against any of these valuations has elapsed, as that closed in March 26. But charities can look to claim 80% business rates relief, and the local authority has discretion as to whether or not to grant relief for the other 20% that's not covered by the 80% relief. That is, I stress, is very much at the discretion of the local authority. Next slide, please. If we can move on to the next thing I wish to mention is tax and subsidiaries. And it's very common for a charity to use a trading subsidiary in order to maintain and preserve its tax-free status. And this is because charities can only earn a limited amount from non-primary purpose trading before the charity is tainted and the income becomes subject to tax. If the non-primary purpose income of a charity exceeds £8,000 or 25% of total income subject to a maximum limit of 80 grand, then the entire income becomes subject to tax. Therefore, to protect the tax-free status of the charity, a subsidiary is set up which will be the source of this non-primary purpose income. This is so the charity is a separate body and it maintains and it preserves its tax-free status and avoids the nasty unexpected tax charge. But one of the issues of this is what happens if the charity charges the subsidiary for undertaking work or vice versa. To avoid this risk, and they charge each other a management charge, but to avoid this risk, we would need to ensure that any charges are taking place at arm's length value, i.e. what would you pay for a third party for this service? This is in case HMRC ever question the commerciality of such an arrangement. A charity and its trading subsidiary can form a VAT group if they are under common control, common ownership, but this creates the risk of creating joint and several liability for VAT debts incurred by the other group members. So if the trading subsidiary's got a VAT debt, it could also put the charity at risk, so you may want to think twice before setting up a VAT group. Now, quite often trading subsidiaries will make a taxable profit, but these profits can be eliminated by making a donation up to the parent charity. However, to make sure that this donation is qualifying and the trading subsidiary doesn't have any taxable profits, the payment will only be deductible for tax purposes if it is made within 9 months of the year end, and this must be a physical payment from the subsidiary up to the charity. Now, I would finally like to mention on this point that for charities and their subsidiaries, we would offer VAT and PAYE health checks to ensure that the organisation is operating in the most efficient way possible. So as I mentioned before, for example, are you offering the most efficient range of tax-free benefits to staff to keep them incentivised? So that's the tax issues for charities that we wish to cover. And now I'm going to hand over to Alan, who will talk about leases.
Thanks very much, Jay. So We're going to start with the key changes to the Charity Statement of Recommended Practice, or SORP. These have arisen from recent amendments to the accounting standard FRS 102. We've had FRS 102 for around 10 years now, and the Financial Reporting Council's aim is to keep the standard up to date and in line with global accounting standards. The FRC make amendments every 5 years or so, and the first set of amendments back in 2017 were fairly minor and gave some helpful simplifications. This second review is more extensive and introduces some more significant changes, which have now been incorporated in the new charity SORP. The implementation date for the new SORP is accounting periods commencing on or after 1st of January 26. So for most charities, we're looking at December 26 year ends, and for Academy Trusts, it's August 27. The changes won't affect every charity, but for some it could be significant. We're going to cover the two main areas affected, which are leases and income recognition. Next slide, please. Starting with leases, we'll have a look at the current treatment and how that will change. But in summary, we're going to see more leases and leased assets on the balance sheet, particularly regarding land and buildings. In most cases, there won't be a significant change to the bottom line of net incoming resources or net assets, but the changes will affect total income, total expenditure, gross assets, and current and long-term liabilities. Consequently, the changes could have a significant impact on a charity's accounts and may potentially affect a charity's size and the required level of scrutiny on its financial statements. So on the next slide, we'll have a look at the detail. Currently, we classify leases as either operating or finance. An operating lease is typically for a fairly short term, and the accounting is pretty simple. The rentals paid are shown as an expense within expenditure as they fall due. A finance lease is where the lessee has the risks and rewards of ownership in respect of the underlying asset. And essentially, this is where the arrangement of leasing is in substance very similar to owning the asset outright. For example, where we're leasing an asset for most of its useful life, or where we may have an option to purchase the asset at the end of the lease term, which we're likely to take up. And for that reason, we show a right of use asset on the balance sheet and a liability for the outstanding lease rentals within creditors. We also have a depreciation charge on the asset and an interest charge on the liability. The right of use asset forms a separate class of fixed asset and is disclosed separately within the tangible fixed asset note. Currently, any asset which doesn't meet the definition of a finance lease is accounted for as an operating lease. So on the next slide, we'll have a look at how this is changing. Accounting treatment will result in more leases being treated as finance rather than operating. The exceptions to this are short-term leases, which is where the lease term is for no more than 12 months, and leases of low-value assets. When we say low value, we're talking in relation to the asset itself, regardless of the materiality of the asset's value to the charity. So what is a low-value asset for one charity will be the same for any other. Low-value assets are those which can be used on their own and are not interdependent with other assets. Bit of a wordy definition, but effectively what it includes are assets such as laptops or desktop computers, tablets, mobile phones, or office furniture and office equipment such as photocopiers and that kind of thing. FRS 102 doesn't give a definitive list of low-value assets, but it does define some which definitely aren't low value, although the examples are mostly assets which we'd usually expect to find in the private sector rather than a charity. However, for most charities, any lease of land and buildings, or really any kind of vehicle lease, would be excluded from the low-value asset exemption. We'll have a look at a practical example on the next slide. So we have a 3-year lease. Let's say it's the lease of a shop. The rent is £10,000 per year, and we're using an interest rate of 5%, but more on that later. With the old operating lease treatment, it was very simple. The rentals paid just went straight to expenditure. If I just move the slide along a bit, now it gets a little bit more complicated. We have to use that interest rate of 5% to take account of the time value of money and discount those annual rentals down to a net present value. And I've put a useful Excel formula for that at the bottom of the slide. So the present value is 27,232, and that is the value of the right-of-use asset that we include on the balance sheet. There's a matching liability shown within creditors. So the initial accounting entry is debit fixed assets and credit finance lease liability. So far, so good. If we move the slide along a bit, we'll see what happens to that liability over the 3 years. In that second section on the right, you can see that we start with a lease liability of that 27,232. We then apply an annual interest charge, which is based on a percentage rather than a straight line amount. This means that the interest charge is greater at the start of the lease than towards the end. The rentals paid reduce the lease liability, and you can see we end up at zero at the conclusion of the 3-year lease term. We depreciate the right-of-use asset over the 3-year term on a straight line basis. So for the last section on this slide, we'll see how this affects the SOFR. Instead of the lease rentals, we now have a depreciation charge and an interest charge. It ends up the same, a total of 30,000, but because of the way the interest is calculated, the charge is front-loaded rather than straight line. The other difference is in presentation. Whereas before we had lease rentals within normal expenditure, we now have a depreciation charge and an interest charge. Some charities use EBITDA as a key performance indicator, and from that perspective, this makes a significant difference. Next slide, please. We also have some practical issues here. So on the following slides, we'll look at these one by one. So the first slide is lease term. You might think the lease term would be obvious, but particularly with property leases, we must consider things like break clauses and lease extensions. We must use our judgment to estimate what we are reasonably certain is going to happen. Are we likely, for example, to extend the lease or exercise a break clause? To answer that question, we need to look at a range of factors, such as any financial penalties that we would need to pay, or the importance of that lease to us. For example, if a charity is leasing a building which meets all of its requirements perfectly, it's unlikely to want to change that arrangement. It will most likely leave any break clauses unused and extend the lease if at all possible. In that case, we would use the maximum lease period as the lease term. However, if the converse was true, it may be more likely that the charity would take advantage of the break clause, and we'd therefore apply the shorter period up to the break clause as the lease term. Next slide, please. In some cases, the lease payments are not a fixed uniform amount from start to finish. They might increase, for example, in line with inflation or by some other calculation. FRS 102 only requires us to take variable payments into account if they relate to an index or rate. Let's take the example of a charity shop. Where the rent on the shop increased with inflation, we would take the inflationary increases into account when calculating the lease liability. However, let's say if the lease payments included an amount that was linked to revenue, let's say it was 1% for the sake of argument, that element would go straight to expenditure because it's not related to an index or a rate. Next slide, please. Some lease agreements may include separate elements for different services included in a lease, such as a building lease, which may include things like a reception desk, security staff or cleaning, that kind of thing. FRS 102 requires us to allocate the rentals paid between the lease element and these non-lease components, using either observable standalone prices for each different element or an estimated allocation, and we can then account for these separately. Fortunately, FRS 102 includes a practical expedient which allows us to account for both elements, or all elements, as part of the total lease cost. And I expect that most charities will take this option to keep the accounting as simple as possible. On the next slide, we'll have a look at the discount rate. This is the other big judgment call. In FRS 102, our first option is to use the discount rate which is inherent in the lease. But in most cases, we won't know what that is and we won't be able to calculate it. It's something that only the lessor really knows. Other options are using what's called either the incremental or obtainable borrowing rates. And this means at what interest rate could we take out a theoretical loan which was equal to either the asset value itself or the total amount of lease payments. These are questions that companies need to answer, but thankfully for charities, the SORP gives us a bit of a get-out-of-jail-free option. We can use the interest rate which the charity can obtain on savings or deposits as our discount rate. So a very welcome simplification there. Next slide, please. And we have social donation leases. And here we're talking about where a charity has a lease which is below the normal commercial rate. We're required to account for the lease using exchange and non-exchange components. Exchange being what we are actually paying, and non-exchange being the amount that we would have otherwise had to pay. The non-exchange element is shown within income as a donation. So let's have a look at an example. Let's say it would usually cost us £75,000 per year to rent our head office. However, because we're a charity, a kind landlord uses their corporate social responsibility policy to offer us an office with a market rent of £120,000 per year at a rate of only 60. So we're offered a better office for less money than we would otherwise have had to pay, a double win for the charity. In this case, we're required to show a donation based on an amount of £15,000 per year, being the difference between what the charity would have paid and the actual rental, and add that onto our right of use asset at the start of the lease. It's important here to note that the donation is the difference between the actual rent and the rent we would have otherwise had to pay, rather than the difference between the actual and market rates. The total difference over the life of the lease is added on to the right of use asset, so the annual depreciation charges will be higher. However, because we show the donation up front at the start of the lease in one go, this creates a timing difference which could inflate our income and potentially affect the level of donations from donors or different reporting thresholds because we're showing a one-off higher amount of income. On the next slide, we'll just have a quick look at transitional arrangements. And thankfully, there's no retrospective restatement here, so no prior year adjustment of comparative figures is required. Instead, at the point of transition, which will be the opening day of the first accounting period, which is affected by the new rules, we calculate the remaining rentals payable on any leases in place at that date and work out the right of use asset and lease liability based on that. There are also some practical expedients again. We can use a single discount rate for similar leases, although we might be doing that anyway if we're using the rate we can obtain on savings as the discount rate. Where there's no more than 12 months left to run on a lease at the date of transition, we can apply the short-term exemption, even though the total lease term may have been longer from the start of the lease. And finally, we can use hindsight to determine those judgmental issues, such as the lease term, if we know by the time of preparing the accounts what's actually going to happen. So let's wrap this section up with a quick poll. Do you think that your charity or academy will need to put any leases on the balance sheet as a result of this change? Okay, so it's looking like it is actually going to be quite an area that's going to have quite a lot of impact on charities. Like I said, it is a complicated area. Please don't hesitate to get in touch if you have any queries about how this might affect your charity, and we'll be very pleased to help. Matt is now going to have a look at the other main changes arising from the amendments to FRS 102.
Perfect, thank you, Adam. And yeah, good morning, everyone. So I'm going to pick things up now on income recognition in line with FRS 102. So going to focus very specifically on how this works in a charity setting, because of a lot of what's written. Sorry, my mouse has just gone. There we go. About this is aimed at commercial organisations and can sound far more daunting, really, than it actually is. So what I'll do, I'll walk through the slides step by step using the new 5-step model, which I'll explain shortly. And I'll keep linking back to what you can actually see on the screen so it's easy to follow. And yeah, I've included practical points throughout you can take away, which will hopefully act as small aid memoirs to consider when you're planning for what effects this will have on your own charities. So starting here, so before we kind of get into the actual revenue recognition, just wanted to touch on disclosures because this is often where charities underestimate the impact. So if you look at the first 2 bullet points, the key message really is that although recognition and measurement may be simplified, disclosure requirements still apply, and the charity SORP applies FRS 102 proportionately. And that proportionality point is really important. This isn't about turning charity accounts into corporate accounts. It's about making sure that where something is material, so kind of large enough to affect the users of the accounts, it's explained clearly for trustees and other readers. The next point there is to be particularly aware of. So disclosures that were previously described as encouraged and now mandatory where material. And a few areas where there which are relevant are kind of leases, provisions, revenue, but only exchange transactions, and again, which I'll talk about later, and tax, so yeah, including whether tax charges nil. So practical takeaway really here is the final line, so kind of focusing on material items and clarity for trustees and readers. So essentially ask yourself if a trustee would reasonably ask a question when reading the accounts. That's usually quite a good sign that the disclosure needs strengthening. Okay, so with that in mind, we'll just move on to the next slide and talk about revenue itself. So this really is kind of the scope area and basically summarizes the entire change, which I'll then go on to explain in a charity context, of course. So firstly, kind of the new charity SORP adopts FRS 102, section 23 for exchange transactions. And then really what this means is it applies where there is a contractual exchange of service or goods. So as you can see, this isn't relating to donations, grants without performance conditions or legacies. So they're kind of what remain as non-exchange income and continue to be recognised under charity SORP in the same way as before. So just to anchor this clearly to what you can see on the slide, kind of dividing income into two separate areas. So one area is a non-exchange income, like I said, so the donations, legacies above, and those rules haven't changed. The second is exchange income, so things like commission services, local authority or NHS contracts, training services, memberships, trading activity, those sorts of areas, and that's where this 5-step model applies. And then that final line to think, so exchange income is now accounted for using a single 5-step model. So just trying to make it practical, kind of where we see confusion in real life. So imagine like a charity supporting vulnerable adults, for example. So if the local authority pays you because you've agreed to provide a set number of placements or hours of support, that's exchange income. So essentially you're being paid to deliver something specific. However, if you receive a grant to support your work in the community, so something reasonably vague like that, so kind of very overarching with kind of no obligation on specific outputs, that's non-exchange. And then the 5-step model just simply doesn't apply. So I guess what I'm trying to say is it's less about the label on the paperwork and more about the substance behind what the income relates to. So the 5 steps there on the screen, but rather than just read them out, I'll just kind of now go through step by step, explain how it works. Okay, so yeah, we established we're dealing with exchange income. So I generally just refer to it as income from here on in, just to save my pronunciation. Yeah, step 1 is identifying the contract. So this step is all about confirming that a contract actually exists. So bullets here kind of practical. So both parties have approved the contract. Rights and obligations are clearly identified. Payment terms are defined. The arrangement has commercial substance. And the contracting party has the ability and intention to pay. And then in terms of some examples, which would be kind of quite relevant, so local authority or NHS, training, education, membership, subscription-based, a bit like the list I mentioned earlier. So practical point here for is that kind of a contract, if you like, in quotation marks, doesn't always mean like a long legal document. It can be kind of like a service agreement, a commissioning letter, funding agreement, funding letter, those sorts of things. That clearly sets out what you're required to deliver. So even if it's called a grant, like in writing or like a contract, if there's a clear obligation to deliver specific services, that's effectively a contract now for these new charity SORP accounting purposes. So really the key is the substance rather than what might be written down. So kind of, are you obliged to provide something specific in return for payment? If yes, then you're likely in this new exchange income territory. Okay, so we'll move on to step 2. As we've now know that we've got a contract, the next question is, what exactly have we promised to deliver? So step 2, about performance obligations, just a technical way really of saying what are the promises within the contract, what really is it that we're doing. So firstly, we need to identify those promises and then work out if they're distinct or combined. So the test for distinct is set out clearly, and it's the beneficiary can benefit from it on its own, and it is separable from other obligations. And then in terms of some common examples, so yeah, delivery of services, access to facilities, ongoing program delivery, all those sorts of things. So when you're thinking about this in reality, it's kind of, you're asking, are these genuinely separate promises or things that we're doing, or are they all part of one integrated program? And that judgment then feeds directly into the next slide, which goes into a little bit more detail. So I'm actually going to start at the bottom of this slide and emphasize on that quote there. So it's kind of, judgment is required and should be documented. It's kind of having that thought process and having that decision all on file, kind of all just the rationale behind it, really. So on the left-hand side, distinct. This is where services can be delivered independently, where elements could be purchased separately, or where there are separate pricing signals, such as like discounts or financing arrangements. And then on the right-hand side, we've got combined. So this is where activities are highly integrated, interdependent, or involve customization or modification of a wider program. So kind of from an accounts and audit and governance perspective, this doesn't need to be complicated, just needs to be kind of sensible, consistent, and explainable. So as an example, if you kind of take like an education program, you might deliver workshops, train volunteers, and then provide kind of impact reporting back to the funder. So on paper, they look like 3 things, but in reality, they all may be part of one overall program. So the judgment is whether a funder would see those as separate promises or simply different parts of one overall service. And we'll take a look at a similar example on that shortly when it comes to the numbers. So yeah, we've now completed kind of the first 2 steps of this new 5-step model. So now moving on to step 3, it's kind of going to be working out what we're going to be paid. Obviously, a very important part. So yeah, step 3, determining the transaction price, or in other words, the amount the charity expects to receive. So one thing to consider here is there can often be variable elements you need to think about. So like it says on the screen there, discounts, penalties, performance-related adjustments, any clawback issues. So this kind of particularly relevant for outcome-based contracts and service level agreements, SLAs, which can affect the overall transaction price, subsequently affect how it's accounted for as well. Final point on that, just to quickly mention time value of money. So if we're kind of going beyond a 12-month period, I think kind of in charitable terms, I think it's only really relevant where amounts are material and cash flows are heavily weighted to one end of a contract. So likely to be theoretical in most circumstances, but worth remembering nevertheless. So a good practical check at this stage is simply to ask yourself, kind of, is there anything in this contract that could change the amount we ultimately receive? And if there is, it's kind of take a step back, consider what the options are, see what effect this has on it, and what changes need to be made. And then, yes, so once we've answered that, we'll then move on to allocation, which is step 4. just a minute. There we go. So yeah, allocating the transaction price. So firstly, total price needs to be allocated to performance obligations or promises, or the things we're doing. So essentially the service which has been agreed, and the price for that service. The second point there is kind of the key phrase on this step. So it's kind of based on standalone selling prices. And where those aren't observable, reasonable estimates are used. And then the final point there just explains where this often matters most for charities is where there's multiple services under one contract, very common, or mixed service and support arrangements. So this has been kind of about allocating based on relative value, not internal budgets or cost lines. And to make that clearer, the next slide walks us through kind of a worked example. So typical scenario here, I've used round figures just to keep it simple. So let's imagine we've got a charity which enters into a single contract with the local authority for 100,000 to deliver a program including service delivery, volunteer training, monitoring and reporting. So the standalone values on the left-hand column there would total up to 120,000 if provided separately, which tells us the relative value of each component being the 90, 20 and 10,000 there. Then that gives us the middle column of 75, 70 and 8% just split pro rata. So the difference reflects essentially a negotiated or commission discount when bundling services into one SLA. The key point on this slide is that the 100,000 is allocated across the services based on those relative standalone values. So in turn, you end up with the right-hand column split down there on the side. So I think the main kind of important thing on this allocation really is timing. So in this example, so the training might happen at the start of the year. It's about 20,000. The frontline service runs all year, and the reporting happens at the end. And also kind of this whole program of work may also span more than one financial year. So without doing this allocation, you can easily end up recognizing income incorrectly in a way that doesn't reflect what's actually been delivered. And then the final step, so obviously we now know how to allocate it, and now it's on to how to recognize that income. And we've got kind of two choices really, or two methods, shall I say, based on which one's relevant. So revenue being recognized either at a point in time or over time. And the decision for which method to use will depend on the service being completed. So firstly, kind of point-in-time recognition applies when a specific service or contractual output is delivered and no further obligations remain. So for example, kind of one-off training or events, or the sale of publications or resources, those sorts of things. Or secondly, the overtime recognition applies where services are delivered over the contract period and benefits are received as the charity performs it. So such as the service I mentioned earlier in the example on the previous slide. So simple way to think about this is kind of, if we stop delivering today, would the funder reasonably say kind of, we've had value for what you've done so far? And if that answer is yes, you're almost certainly in the kind of overtime territory. And then once that fifth and final step has been confirmed, kind of is at that point that the revenue can be recognised either at a point in time or over that period of time. So that's the new kind of 5-step model in a nutshell. Of course, I'm sure there'll come times in reality that kind of unsure how this might apply to your own contexts, but kind of taking it step by step through that new 5-step model, hopefully be able to kind of ascertain the correct treatment. But obviously, if not, then obviously here to assist and kind of offer that advice. And then just to wrap up on the final slide, with regards to kind of revenue on today's webinar. So now we've kind of gone through the new model. This slide brings us back to disclosures. So just going to quickly run through what will be required to be disclosed within your charity's financial statements. And it's all really just the changes here. So regarding kind of material exchange income. So categories of revenue, kind of split between the different areas of income which are relevant to your charity. Recognition policies. So this is the accounting policy which essentially describes the 5-step model, essentially, about how the charity is recognising the revenue. Significant judgments and estimates. This is only required where it is deemed to be relevant. And and there is separate and additional disclosure just to explain why this is the case. Contract balances. So again, kind of with regards to the balance sheet for any amounts outstanding as at the balance sheet date. And that final line just sums it up nicely from the charity SORP's point of view. So the aim is transparency for trustees, funders and regulators, and just basically bringing everything in line so it's kind of comparable across different organisations. Yes, so just going to move on to, I think, our third and final poll of today. So yeah, question is kind of what revenue streams will this affect for your charity? So you can type in kind of any, it's not like a multiple choice here, you can kind of put it in all the different streams that you like. Just thought it'd be helpful really to see where you all think this will affect your own charities in the real world. So yeah, just going to have to give everyone a few moments to fill that in and pop their answers into the box. So yeah, I think everyone's been saying throughout, kind of if there are any questions, please do pop them in the chat box. If we have time, we'll answer them live, but if not, obviously we'll list these out and answer them within the material we'll send across following today's webinar. There we go, got some coming up. So provisions, contracts with local authority, commissioned income, memberships, yeah, all seems to be things which I mentioned earlier, which is promising. Investment. There we go. Memberships. There we go. Now it's finally catching up with things. We'll just give it a few more seconds. Membership seems to be the main one. Sponsorship. Events, tickets. Yeah, all the sorts of areas which we thought would be relevant. Wonderful. Okay. Thank you. Yeah, I'll now hand across to Matt Pickett. And yeah, thanks so much.
Good morning. I'm just conscious of time, so I apologise. I may whiz through these slides a bit quicker than originally planned. But I'm just going to cover bits on the Charity SORP 2026. So in addition to what has already been discussed with Alan and Matt, there's a new tiering structure which is come into reporting, where previously charities were either classed as small if under 500k of income or large if over 500k of income. There are now 3 tiers, again, but based on income up to 500k, 500k to 15 million, and over 15 million. We've listed some of the key accounting requirements on the slide, with one of the changes being that charities with less than 15 million, so tiers 1 and 2, don't have to do a cash flow statement, which will please some people. Next slide. Just a quick slide here on the application of the SORP and who it actually applies to. There's a few details on there, but basically it's everyone other than if you've got if you're doing receipts and payments accounts, so you're unincorporated and your income is below 250k. But as I'll explain a bit further later on, the thresholds are moving up from 30th of September, so that figure will become 500k. So if we just move on to the next slide. Just want to discuss a few bits on the trustees report. So the new SORP has been beefed up some of the disclosures, and this is where the new tiers really do take effect. Impact reporting is something that must be disclosed in all trustee reports, detailing the charity's achievements. This is enhanced from previous reporting requirements. All must report on volunteer contributions, with this enhanced in the higher tiers. Sustainability reporting is a must in tier 3, and it is encouraged but not required in tiers 1 and 2. There are also requirements for disclosures on cyber risk and further guidance on reserves and going concern reporting. To quickly focus on impact and sustainability reporting on the next couple of slides. So, firstly, impact reporting. Many charities are already quite good at telling some of their story and noting their achievements, which is the requirement for tier 1. Requirements of tiers 2 and 3 beef up the reporting further to make it a requirement to specifically note the impact the charitable activities are having both on individuals and on society as a whole. I've included a couple of links on the slide, because a couple of examples of larger charities of how they are currently reporting their impacts in their trustee reports. These are worth a read, and there's plenty of other examples out there where kind of larger organisations are already trying to do this. So this is going to give you a few good ideas. I should note though that these examples were prepared under the previous sorts, but they should give a good flavour. So on to the next slide, which is for sustainability reporting. Sustainability reporting is something that some of the larger charities are already doing as part of their other corporate legislation for medium and larger companies, which kind of already requires this to be done. Therefore, there are again some good examples out there. I've again included a link to the Great Ormond Street Hospital charity, which I think is really good. It kind of splits out into the various sections, the relevant sections, which are environmental, governance and social. As noted, these requirements are only a may for tiers 1 and 2, rather than kind of compulsory. With all the trustee report changes, including the impact and sustainability reporting, which I've briefly covered, we have a disclosure checklist which we can share with you, and that will give you a bit more of a steer in this area. It would detail all the updated requirements in the trustees report and in the wider accounts. On to the next slide. So impact on balance sheet. So away from the trustees report, the new SORPs will have the changes will have an effect on the balance sheet. As already discussed by Alan, the inclusion of the right of use assets and lease liabilities will increase their figures on the balance sheet. Charities will need to consider whether bank covenants will contain ratios that will be affected by these changes, particularly ones involving debt, which will increase. What view will banks take if you're now not compliant? So this is a kind of a practical consideration that's going to need to be thought about now, and conversations be held with banks. But from kind of disclosure, will long-term bank debt suddenly need to be classified as current rather than long-term, and how will that make the viewer of the account view it? Also, some charities currently out of scope of statutory audit may suddenly require an audit if their gross assets increase sharply. If over a leased asset, which now will be included within gross asset calculation, the expected increase in audit thresholds for assets to 5 million should help, but charities will need to be aware. So I think again, look at this early. There are no changes to the rules for charity groups to consolidate and show group and company balance sheets. However, as a note on the slide, there is an expected increase in the thresholds. Again, there'll be need to be awareness as to whether the changes will put charity groups in or out of scope for consolidation. Right. I've already touched on it on the kind of expected changes on some of the earlier slides, but just to summarise, these are the expected changes from 30th September 2026. So it's, quite a few of the thresholds are increasing. So with your planning, consider these changes. On to the next slide. So I have flown through these a bit, but the kind of actions which need to be kind of taken away from the change in the SORP. The key message, I think, has to be look at the potential impact now, plan early, use fact sheets, use disclosure checklists. And if in doubt, ask for advice and assistance. We're always there. Any one of the team you've seen today, please speak to them. So I'll now hand over to Michaela.
Thank you, Matt. So under this sort of general sector update, again, I'll whiz through it quite quickly. There's lots of little topics in no particular order. So firstly, I wanted to remind you that if you are taking on any new lending as a charity, you need to consider a Section 124 report under the Charities Act. This is often missed when you're busy negotiating a loan with a bank. you're so grateful that you've got through the process and finally got your loan, that you've forgotten that you need to do this report. Unfortunately, if this report isn't done, then we do have to report back to your board in the audit findings report. So do speak to us if you need any help and guidance around that. We can always help. Transparency in the sector is absolutely key, still more important than it has ever been. So, my sort of words of wisdom here are, if in doubt, disclose. But, do take legal advice. Wanted to mention the possibility of extending filing deadlines. So if any of you are struggling to get your year-end accounts filed for whatever reason, Companies House is quite amicable to an extension of 3 months, and we are seeing those extensions being agreed to very easily. But of course, do not forget that if you do get that extension from Companies House, you also then need to inform the Charity Commission, because in theory then your accounts will be late by a month. So picking up on a couple of new bits of legislation issued, there was the new Charity Governance Code that came in on the 3rd of November last year. The Charity Governance Code is a soft code. It's based on principles of either comply or disclose why you have not complied. The key changes that came in this year were around stronger emphasis on diversity, updating and reinforcing the expectations around integrity, and really an increased focus on digital transformation and environmental responsibility. So the code is quite practical. It covers all sizes, so that helps to reduce any barriers to adopting that code. So do take a look, and we will be sending a link after the webinar. I'd recommend that your trustees and senior leadership team review this code promptly and put it on the board meeting agenda, again, so that they can pick up any points that are relevant to your charity. Just before the code was issued, there was a new fundraising practices code, and again the Charity Commission issued a guidance CC20 on this. Again, we'll send a link after the webinar. And this sort of fundraising practice shifted to a more principle-based approach. The code is much shorter than it used to be, 45% shorter, and it really focuses in on the core principles instead of very prescriptive rules. So it's designed to be more flexible and proportionate given the size of your charity. And it's trying to sort of future-proof, obviously, because there's lots of new ways of fundraising now and technologies being used, and therefore it was trying to incorporate all of that so that it's still relevant in years to come. The Employment Rights Bill is the next one there on the list. There are many points here that will affect charities, and of course people are often your largest cost and of course your best asset. So do consult with your internal HR or your HR support that you have. There are various implementation dates throughout this bill, 2 of which that came in this month were around strengthening statutory sick pay and that removal of the lower earnings limit and waiting days. And then the paternity and unpaid parental leave becomes a day 1 right again. But there are some more dates coming up, so do make sure you've looked at them, costed them into any contracts that you have, and work through it all. On to cyber then. Cyber still continues to be in the top 3 risks of most charities' risk registers, and rightly so, as the sector is seen as an easy target. And, we do see ransom demands on the increase. So I would recommend that you check your insurance policy in this area and remain vigilant and undertake that staff training so that they can spot those phishing emails that might be coming in. Your IT support is key in battling this problem area. With it still being the biggest threat, we still see it being hindered sometimes also by outdated equipment. So do take a look at this area. Then only in February, it was announced that the electronic filing of your accounts was to come into force, has been now delayed until 2027. This could be a big area for charities because a lot of you produce lovely, glossy sets of accounts, but at the moment they don't enable digital filing. And so the government has said they would give us 21 months notice of any change, and therefore the software suppliers and everybody else can then come up with a solution of how we can get these accounts digitally filed. And then last on the slide, I thought we couldn't really not go by without mentioning the Middle East conflict. It's obviously a worry for us all, but effects that we are seeing on charities are in terms of increased cost of fuel and heating, and depending on what contract you are tied into, that could have a huge effect on you. Also, in respect of your investment portfolios, where the values have gone up and down throughout the year, all over the place, very hard to look at it in the short term. This sort of geopolitical environment we're in, you need to take that long-term view on your investments. So we'll move on finally to the next slide, which is just a summary confirming, what we've covered today, a few tax developments, the major changes around FRS 102, a few tweaks with SORP 26, depending on the size of your charity. And so do keep on top of all these changes. In order to survive and thrive, we recommend that governance and key planning are key agenda points for you at each and every one of your meetings. Okay, so next slide was just to let you know of the support that we can give you. We've got various newsletters and a roundtable event for your CEOs if they wish to join us, which is on the 25th of June. I really hope that today has given you a good update and helped with your CPD targets. And so that really just leaves me to say we've got all our contact details on the final slide, and we will send out the slides, the recording, the links and the documents that we've mentioned, and obviously a feedback form if you want us to cover anything else specific to charities in future. That just leaves me to say thank you very much to the HWB speakers, and thank you all for attending, and I hope you all have a good week.